Hello, and today we'll be taking a quick look at Norway's trust fund, not trust fund, but investment fund. Uh, More specifically, within it, the Norges is saying it wrong. Norges Bank Investment Management, more like their actual investment arm. Because again, these guys, well, in practice or for much of their history, they have been pretty passive, right? Like the common saying is they own 1.5% of every public company in the world, but of course, that sounds pretty passive, right? If it's 1.5% of every company, I'm sure Russia might not be in the index anymore. Yeah, average 1.5%. Just take that at face value. So that's that. But of course, recently, as part of this handy document, they have decided to change some of their allocations. Of course, their new guy in charge, Nikolai Tangen, who does have a decent podcast. I can't recall the name of. Let me check. The name of his podcast is In Good Company, where he does like 30-minute interviews with various CEOs, which is actually he does ask some superfluous questions that really, most of the questions he asks really aren't business focused. They really aren't actual quantifiable. They're more so like, if they are business questions, they're very qualitative, vibes based of like, what your company do, what is he does ask like sometimes some specific questions about like we was talking to like Ferrari's CEO, like what do you think of like Formula One or those things. So but again, it's short listen, and so it's a good listen. But anyway, he's a new guy, and so him, of course, being a former hedge fund manager, it makes sense to want to turn this massive 1.3 trillion investment vehicle towards a bit more active in some ways, right, to optimize. And again, right, and I think the big point they make is that when it's a long-term investment perspective, right? I'm pretty sure Norway and certainly these guys, they don't have a 10-year time horizon. They implicitly probably have like 30-year, more than that, right? Like decades at the least timeline, right? And with that, right? If the time horizon, because even if you're just which is extremely unique, right? Because if you have an infinite time, because like if you just have 100-year, just have an 80-year time horizon, like you are basically have a longer time horizon. Like 99% of people, if you're a family office, sure you might plan out for generations, but again, like for the most part, it's the same about yourself, right? You graduate high school, 18, 19 years old, 17, 19 years old, and so what? Say you live to 80. So from say some 20, you're 20 to you're 80, you have 60 years time horizon, right? Which again is very long, right? Especially when the average holding period for a stock nowadays, at least for the U.S., is like half a year, only 6 months. So again, sorry, think about so a 5-year time horizon, that's pretty long. A 20-year time horizon is pretty long. If I'm an endowment, I'm allocating capital to a VC fund or something, or if I'm the UC of California and I'm giving $4 billion to Blackstone, right, and 6-year lockup, right? You think that's a long time horizon, but it's still not an infinite time horizon. And the fact that the Blackstone had to promise them 11.25% guaranteed returns. Of course, Blackstone take fees, and so it's kind of like if they underperform the 11.25, the UC will work out fine because they get the guaranteed return. If Blackstone overperforms in B REITs, they're in public, like retail investor facing REIT. So the upside goes to Blackstone, the downside protection goes to UC, and you get 11.25% return. Can't complain about that, especially when your $4 billion compounds to that big of a capital base. But again, right? But there's still, even again, like this is right. Everything is investment horizon constrained, right? If you're a PE firm, you have a 5-10-year investment horizon. If you're a VC firm, you have a time horizon. Even if you're an individual investor, where you have the most flexibility and the most ability to be disciplined, you still have a I was going to use this whiteboard, but it might be a bit finicky to use. What would be helpful would be graphic though. But anyway, so and again, to that degree, like these guys here in Norway have a really unique strategy in that they literally have it to the degree that anything can be infinite. They have an infinite time horizon, or that's their mandate, to be as long as possible. And so, and with that, it's again like that point I'm making this is that it's so unique, right? Because even it's honestly only constrained to say like university endowments, sovereign wealth funds, are functionally the only two pools. Because even if you're, I suppose in a abstract sense, maybe like if you're an asset manager, you have perpetual capital. Maybe then you have like an infinite, as close to infinite as you can get time horizon. But it's extremely various. It's only like those three categories. If you're a hedge fund, you're not thinking about perpetual capital. You have even if you're even if you have a long time horizon, you still have like a 20, 30 year, 40 year max before you call it quits and call it a day. And then unless of course you make the pivot to asset manager, but then right you fall back into those three buckets. So again, this is extremely unique, and of course you have other sovereign wealth funds like Mudabala for I think the Qatar or UAE, one of the two. But yeah, a lot of like those Middle Eastern states have sovereign wealth funds. Of course, those guys, I think they also have perpetual capital. Of course, one thing, like those guys don't get written about as positively with as much of a glow as say Norway does, which is is what it is. But at the same time, right, like they. But again, also like Norway does disclose like all of their holdings and like some equity at least, and that's right. Nice, wonderful write-ups that allow me to make hasty content. But again, the point is like it's very unique, right? Because even as an individual investor, we have the most flexibility. You can't replicate what these guys do, because you have a maximum of 100-year time horizon basically. Family office, and I suppose family offices can be tossed in, but even then, family office. Bit of a time horizon. You have some moral hazard. Like maybe you don't like your heirs, so spend it all, donate it all, right? So if these guys, right, like the family office, your mandate's a bit flexible, but these guys, like your mandate is set in stone. But we're again like the real backbone of enforcement to make sure that you maintain that path. Anyways, and so the point is that this massive perpetual vehicle is going from like purely passive, like mainly passive, and being a bit more active. As this article highlights, right? We want to, right, again, to point like time horizon, right? You can withstand liquidity crises, you can withstand volatility or risk. You can move into illiquid markets, not have to worry about. But again, like think about like with FTX blowing up, right? And their bound assets being mistransferred or misused, but something as we have said, right? Like we have enough assets to cover liabilities, just so we can't liquidate or monetize some of these assets, right? And so if and so it's not a perfect analogy because like the actual details are so incongruent, but like if FTX had a perpetual timeline for those assets, right? Or that just goes to show how there's a liquidity premium, or not. There's a benefit to liquidity, right? Which is a function of your time horizon, right? Because for FTX, if you are doing it properly, you would have only have allocated maybe assets at the most risky to like treasuries, right? That are liquid, but because you have a short time horizon, right? You have to meet customer withdrawals. Then you have to have a very short time horizon to be able to meet those, right? Which creates then which limits your options. Whereas you have perpetual timeline, you have a very long way to go to monetize. And so again, like, it's extremely unique. And again, I'm sure as anybody would say, so for your own personal finances, right? Having a long time horizon is extremely helpful, whether compound interest or just being able to withstand volatility or take advantage of volatility, to not be scared about volatility. And so to this degree, then certainly these Norway's Norges Bank fund definitely can. Right. Of course, the other thing, right? And so that's like the benefit of time horizon in the first place. Now, these guys, so the time horizon part has always been in their hand, right? Ever since like the inception of the fund, like in late 1990s, they've always had this like extremely long time horizon, right? No like 5-year or 10-year benchmarks to meet. So they've always had that. Nothing of that has changed. But what is changing is that they're moving from like a mainly passive thing to being a bit more active, making variations in assets, right? Like be more. So we will choose specific sectors. We will isolate specific companies through accounting. Identify accounting mishaps or suspicions. Identify quality companies and take larger stakes in specific companies. Use specific external managers in specific markets. Choose specific private companies to invest in when they go public. Right. So all that is being active and not just picking and buying 1.5% of every listed country or a company in the world on average, but instead actively picking winners and losers. And of course, on one hand, it's a bit pedantic because if you're starting with a $1.3 trillion capital base, I mean, if you stick it all in treasuries or something, right, like you'll be okay, right? So again, it's kind of like, so it's not so much a question of just is like does somebody be worried about if you're Norwegian, but it's more so just it just goes back to like the active versus passive debate and adds in a different flavor because it's not like Warren Buffett talking about like Warren Buffett's S&P 500 index bet versus a hedge fund bet versus the hedge funds. It's more so like its own category, and it goes to show that like it's a real risk, as Howard Marks says. To outperform, you have to be different from the market, right? And so if you're just carrying the basket of every company in the world, like essentially your own index, right? You can't outperform essentially, but you can't underperform, right? But again, as Howard Marks says, to outperform, you have to be willing to take on underperforming. But again, I get to the degree that these guys are already own 1.5 trillion or 1.5% of every company, listed company on average, then they already are bigger, like different than many indexes in that sense, right? So in terms of their weighting, because I'm pretty sure even like say some of the MSCI, like global indexes, like don't perfectly line up with how these guys are. But again, the general consensus format is like they were pretty passive, right? Passive is a way to get, like you'll get the market rate, right? But of course, both these principles, right, make you a bit more active, then you open yourself up to greater performance, but also underperformance. Now, the one thing to be said is that with that underperformance, overperformance discussion doesn't often include the fact that these guys have an infinite time horizon, right? And I think that infinite time horizon tosses in a wrinkle to the risks or downside from being more active. And so honestly, to the degree like to be more active, having infinite time horizon would help you. Now, my one thing to point out as a downside to that is that, well, sure, you're being more active, but using the long-term time horizon. But none of these elements that they identify really are long-term, really align with that, right? Like you're still like this is all stuff that it's all stuff that your average long-short hedge fund does. It's all stuff that your average mutual fund or actively managed ETF does, right? But they're not using any like really idiosyncratic things. Like what would be really idiosyncratic would be like, I think during COVID, some like central banks issued like 100-year bonds. Of course, I'm not sure what the interest rates around is, but like 100-year bond, right, would have to carry a much higher interest rate, right, or coupon rate or whatnot to entice you, right? Because 100 years is will that country still be around? Will that central bank be able to? Will that country be able to have enough tax dollars to nominally pay you back? Keep on paying you your coupon payments to time value of money. Again, 100 years, you discount anything by 100 years, even if it's 1.01. $100 face value, 100 divided by 1.01 to the 100. I mean, over 100 years, everything, the present value of anything in 100 years is much lower. And again, right, like in 100 years, none of us are probably going to be around except for the extremely, the very edge of the distribution, right? And so, but and again, I don't know what the bonds are, and probably in 100 years you can have better idiosyncratic opportunities. But again, like that's something that you would think that would be something that you could do if you're like Norway and you have this infinite time horizon, is to look into like those like extremely long dated opportunities. I suppose if the external managers, maybe that references like venture capital or some aspects like that. But yeah, all of this to me seems more so just like public market, just like your long short hedge fund being a bit more active, right? I mean, of course, like one thing like fees and stuff, it's not concerning. If you're 1.3 trillion capital base, it's very small. Like a tenth of a percent of those assets under management to fund your actual operations, but none of this is really leveraging the unique position they've got, in my opinion. Of course, a lot of that is in reference to equities. See, the fundamental research part, right? Like market exposure, right? Just like track the market, get your beta, get your market return. But the fundamental research part is a bit, because that's literally turning the fund, or at least a part of the fund, into more of like a long short type of, maybe not short. They won't short most likely, but just more of just like a long only fund, which I don't know. Right, and then you get into all your fallacies, right? Of not getting the cycle right, like which sectors outperform or underperform. If it's too consensus, then should you really be overweight towards that, right? It creates much more difficulties, right? Like security selection. I will say one thing though, because like the fund does publicly disclose their stuff, their holdings. I suppose it will be just as like Berkshire Hathaway's. What's the form called? 13F, just as a like Berkshire's Hathaway's 13F gets analyzed to see what they've bought or added to or sold during the quarter. I'm sure then that with these guys will be interesting to have like one more pretty reputable thing that people can take a signal to. And again, right, like given the fact that again like the guy in charge, Mr. Tang, like did come from a hedge fund, it makes sense then to want to be a bit more active. Recently, that you'd have confidence in this guy leading your path to be a bit more active. Again, like they're not becoming a long short hedge fund, long only hedge fund. They're still like aware of being wanting to be long beta. But again, like so your little optimizations. Again, like you can get some alpha, right? But maybe you can also get some underperformance, and then right, presumably you're going to beef up your staff to handle this, right? Especially when you have a global investment basket. Fixed income bonds. Again, this is kind of like if you want to be a bit more creative, this is kind of where you'd want to. Again, they're doing security selection, right? So they're. I suppose with a bond, it's a bit easier to do some screening and stuff. But then I guess you're a bit dependent on like Moody's and S&P. I imagine like their ratings play a big part if you're trying to automate or like streamline any due diligence or fundamental analysis of credit. But again, I think fixed income, like with equity, there's not really if you want to take advantage of your long-term time horizon, your infinite time horizon, you just stay long the market. You don't need to pick and choose really. You just be long the market because all of academic finance does everything. All outperformance gets competed away. Any superior return on capital returns to like your weighted average cost of capital over time, or your cost of capital over time. So everything converges to the median is certainly like the academic finance, and certainly over 100 years, it's things like again just as like everything essentially reverts to the mean. So again, like if 70% of your capital is of your fund is going to be equities, and if being a bit more active doesn't really have the most benefit to equities, Fixed income being more active, I think, can be beneficial. Of course, I don't think they're going to be like Apollo, moving into like distressed credit. But again, credit, it's a game of as I think Charlie Munger said, it's a game of omission, not of commission. Omission being like you leave it out, commission like you make a mistake by being part of it. And so fixed income, right? Like your upside is very limited, like 100 cents on a dollar plus coupon payments. But if, again, you can lose it all, it gets severely impaired. So it's a game of like omitting investments. I might have used the omitting commission wrong, so don't mock me. But again, but fixed income can definitely see like the benefit. Real assets is now probably one of the areas that having infinite time horizon is really helpful. But in there, and there's not really any of these really. All of this to me is like equities or fixed income, none of which is really real assets. But again, I think real assets, again, you have an infinite time horizon, right? Just as like we saw at Blackstone and BREIT, how real estate like could agree with like the central thesis, the long-term benefit. But again, if you have to like meet investor redemptions or maybe like a bad hurricane or natural disaster, right? Then you're going to be hit by that. But if you have a long and be impacted, have to make decisions around that. Maybe not pursue some projects because you have to discount that risk. But again, you have infinite time horizon, then you have you can be much more expansive then with that. And again, so like real estate, like it's like land is relatively finite. And so I think if you have infinite time horizon, real assets would definitely be one of the areas that they can take advantage of. But again, that's not really what I'm seeing in what they've identified. Because again, like moving into like real assets, like that'll be very different. And it probably does like cause much more real world issues, right? Like what's the difference? How much will people distinguish between Norges versus say like being in Norway, right? Just again, like to parallel like how like those like Middle Eastern sovereign funds get like labeled as being one and the same entity as the government, right? Of like say they're acquiring like a sports asset, like a football club or properties, right? And so real assets does create much more issues, like real world technicalities. But just from like the intellectual, if you have an infinite time horizon, if I have to compare real assets, fixed income, or equities as to which one benefits the most from having an infinite time horizon, like it would have to be real assets, just because like real assets from like the face of it is pretty distinct from the other two. But then if you have an infinite time horizon, real assets is definitely because is definitely where having a like the issue of time is extremely present with real assets. Because even if you're fixed income, right? Fixed income, like your bonds have 5 years maturity, 10 years maturity. It's a very fixed, a very guaranteed. So it's your time horizon with fixed income. Of course, like again, like you're reinvesting and all that, but just from like a very like binary thing, right? Like you buy a bond that's a 10-year bond. It could get your money back in 10 years, then you reinvest that principal plus coupons into a new 10-year bond, right? So it's just like a recursive time is flat type of wheel, right? It benefits the most from being able to like perpetually like have guaranteed capital essentially, and just keep on growing it. It's not a flywheel because it's not really going fast, but right, just a perpetuity machine. Equities does benefit because again, being able to volatility, right, just be long the market, right, is good, and it's something that again is unique because that time horizon can't be met. Well, once you get past 100-year time horizon, you're basically passing because that's like 2 or 3 generations essentially of like your family office, individual investors, right? Your lifetime. So it's going 100 years, right? You got people be equity, yeah, probably like so second place behind the real assets. But real assets again, just being able to be time insensitive is such a big difference that really can't be understated. But again, and so again, if I was part of the Norway, I'd be really interested how to do real assets. Now again, maybe like when they say partners listed and unlisted real estate, that makes me think like so they're going to go to like go to Blackstone. And so if you're just being long, if your exposure to real assets is through like a dedicated asset manager, like a Blackstone, maybe like a what's that one Canadian BAM, Canadian asset. There's that Canadian asset Greenfield. Is it? Oh my god, I forget. Canadian asset manager. Oh my god, I can't remember it, but it's like a Canadian firm where they split their two lines of business. Uh, I can't remember, right? But if you're just going through those guys, then kind of it's what you come to some agreement, like you see, like the University of California did, gets best of both worlds. But again, yeah, not really leveraging the opportunity to the most. That's not the most. Is your standard mumbo jumbo, ESG, having integrity, all that good stuff. But again, so this was that was in depth, but I just really wanted, because when I read this, I just really want to highlight how unique like the time horizon of like sovereign wealth funds are in the first place, having essentially an infinite time horizon. But then also from that, then like if you want to be a bit more active, and how being more active combined with infinite time horizon is sincerely a major competitive advantage. But that competitive advantage or the benefit of it differs between the specific asset class that you're talking about. It is the big point, right? So to summarize, having a longer time horizon is better. Like all things equal, having a longer time horizon is better. Give me a 5-year time horizon versus a 50-year time horizon. I'll take the 50. Right. And so then, and the only people who really have infinite time horizons are basically sovereign wealth funds, maybe perpetual capital at some asset managers, but at this type of scale, it's going to be sovereign wealth funds. I suppose maybe some insurers, some like the insurance companies get tossed in somewhere, but right. And so within that, right, of having infinite time horizon, where does that benefit become most pronounced? It becomes most pronounced in real assets, not so much fixed income, not so much equities. But again, just having a long time horizon, just like it takes so many issues off the table. If you think about it, I'll leave that to the comment section. But hey, kudos to Norway, right? And again, it'll be very interesting because it's just a strategy document. It'll be very interesting to see like where they actually become more active. Do they focus mainly on equities and fixed income, or do they branch out real assets? And then of course, does their selectivity and active management provide them alpha, or are they underperforming, or still just capturing beta minus some additional expenses? But that's something we'll see. And of course, it will be interesting roadmap. And of course, Norway's model does differ from say something like the public investments, the PIF of Saudi Arabia, or Mudabala from I think the UAE. So, but again, it's why finance is so interesting. So, anyways, thank you for watching. Try to maximize your time horizon. That's probably a good thing. Or just recognize what your time horizon is. It's 2023. My time horizon at best is going to be 2100. So what? Only 77 years. That's and but hey, such is life. Such is time value of money. So anyways, thank you for watching. Leave any thoughts and comments. Continue to be safe.